7 companies control 85% of AI infrastructure. Here's the mechanism you can't see. This isn't innovation, it's the Dutch East India Company playbook, 400 years later, and we're at the lock-in stage right before extraction. There are 5 mechanisms controlling AI infrastructure. I'm going to show you each layer, from the surface story about innovation down to the extraction machinery underneath. In a nondescript conference room in Seattle, 2023, a Microsoft executive presents Azure's AI roadmap. Slide 17 shows a 3-year capacity plan. Slide 18 shows pricing optimization. What nobody explains: they're building enough compute infrastructure to meet demand, but they're holding 25% offline. Just like the Dutch East India Company kept spices in Amsterdam warehouses while plantations harvested more. Artificial scarcity, coordinated capacity discipline, the same playbook that extracted wealth for 197 years. The question isn't if cloud providers will extract, it's whether enterprises notice they're being locked into 60 to 70% margin infrastructure before their switching costs exceed their entire annual profit. This is lever 1, the empty core paradox. Here's why this matters to you. Every AI product you use, from photo search to voice assistance to code completion, runs on cloud infrastructure that charges by the millisecond, and those bills are embedded in every subscription price you pay. The 7 hyperscale cloud providers, Microsoft Azure, Amazon AWS, Google Cloud, Meta, Oracle, Alibaba, Tencent, collectively control 85% of AI compute capacity, generating $200 billion annually in revenue. And here's what they actually do. They rent out commodity hardware. That's it. They didn't invent GPUs, NVIDIA did. They didn't discover the transformer architecture that makes AI work, academic researchers did. They didn't create the open source frameworks everyone uses, those are collaborative projects. The cloud providers operate data centers and charge you to use computers they own. Think of them as warehouse operators in the spice trade. The Dutch East India Company didn't grow spices or manufacture ships. They controlled warehouses and distribution. By 1650, they captured 70% margins on cloves they purchased for 1/300th the Amsterdam selling price, extracting wealth while creating zero fundamental value. The VOC didn't grow nutmeg. Indonesian farmers did. They didn't invent ships. Dutch shipyards built those. They controlled access. They owned the warehouses where spices had to be stored, the ships that transported them, the auctions where they were sold. Infrastructure middlemen capturing asymmetric value. The cloud providers do exactly this for AI compute. NVIDIA manufactures H100 GPUs, but you can't buy them directly. NVIDIA allocates 80% of production to existing cloud customers. Want to train a frontier AI model? You must rent compute from Microsoft, Amazon, or Google. There's no alternative at scale. The mechanism is the empty core. The most valuable position in any value chain is often the one creating the least fundamental value, just controlling access between creators and consumers. Cloud providers sit between GPU manufacturers and AI product builders. They create no chips, no algorithms, no models. They operate power-hungry warehouses and charge rent. Here are the margins that prove the extraction. AWS operating margin runs 35 to 40%. Azure approaches similar levels. Google Cloud recently turned profitable at 25% plus margins. Compare this to competitive industries. Walmart operates at 2.5% margin, Toyota at 8%, even Apple, famously high margin, runs 30% on hardware that requires inventing new technology every year. Cloud providers charge 60 to 70% gross margins on commodity compute infrastructure. That's not innovation pricing, that's monopoly rent. Here's what this means for you: $500 billion in AI infrastructure spending over 2022 to 2025 equals $3,800 per US household. That cost isn't absorbed by cloud providers, it's financed through every product and service you buy. Your $10 per month ChatGPT subscription, your employer's productivity tools, the AI features in your phone, all carrying embedded cloud rent. And unlike hardware, you buy once. This is perpetual extraction. The compute meter never stops running. The empty core creates a wealth transfer mechanism. Engineers building AI products generate real value, new capabilities, solve problems, productivity gains. But 40% of enterprise cloud spending, $1.3 million per year for average large companies, represents vendor tax. The lock-in premium over what competitive infrastructure would cost. That's $1.3 million per company, not going to salaries, R&D, or lower prices. It's being extracted by infrastructure middlemen. You might be thinking, but they provide valuable infrastructure services, reliability, security, global scale. They deserve to make money. And yes, operating data centers requires capital and expertise. A fair return would be 15 to 20% margins, similar to other capital-intensive infrastructure businesses like utilities or telecom. Here's the problem with that assumption. Margins are 3 to 4 times higher than infrastructure norms, and rising. AWS operating margins increased from 25% in 2019 to 35% in 2023. They're not getting more efficient, they're extracting more. The infrastructure is the same commodity hardware. What changed is customer lock-in reaching critical mass. Once switching costs exceed 40% of annual spending, 18 to 24 months of engineering time plus migration risks, they can raise prices with impunity. That's the empty core, infrastructure rent-seeking disguised as innovation. The first lever of control. Here's the second, how 7 competitors coordinate capacity without ever needing to talk. This is lever 2, the smoke-filled room that isn't. Pattern check. We've revealed one of 5 mechanisms, the value inversion. Now we go deeper into how coordination happens. Here's why this matters. From late 2023 through 2024, all 7 major cloud providers announced massive AI infrastructure spending, $50 billion to $100 billion each over 2 years. Microsoft, $80 billion. Amazon, $75 billion. Google, $75 billion. Meta, $37 billion. Oracle, $50 billion, within 6 months of each other, all citing the same AI supercycle narrative, all committing to unprecedented capex. And here's what that coordination prevents. Price collapse from oversupply. Picture OPEC meetings, but entirely legal. The VOC didn't need secret meetings to maintain spice prices. Ship departure logs were public, warehouse inventories visible, auction results known to all traders. Perfect transparency enabled coordinated capacity discipline without illegal collusion. Everyone could see everyone, else limiting supply. When oil producers coordinate output, antitrust laws trigger. When cloud providers coordinate capacity deployment through synchronized CAPEX announcements, earnings calls, and industry conferences. Perfectly legal. No smoke-filled room required. Everything happens in public. Satya Nadella announces Azure's AI infrastructure plans on an earnings call. Andy Jassy discusses AWS capacity the following week. Sundar Pichai details Google Cloud's build-out the next quarter. They're not colluding, they're signaling. Each announcement tells competitors, this is our capacity trajectory. Match it or risk triggering a price war. The mechanism is transparent coordination. Here's how it works in practice. Signal 1, synchronized CAPEX announcements. All major providers announced $50 billion plus AI infrastructure spending within a 6-month window, Q4 2023 to Q2 2024. This wasn't coincidence, it was coordination through public signaling. Each announcement established a capacity ceiling. We're building this much, no more. Signal 2, utilization targets. Every cloud provider reports utilization metrics in earnings calls. The magic number, 75 to 80%. Above 85%, they signal more capacity coming, prevents competitors from building. Below 70%, they signal demand softness, prevents oversupply. This narrow band maintains scarcity pricing. Signal 3, NVIDIA allocation. Transparency, NVIDIA doesn't sell H100 GPUs on the open market. They allocate via relationship. Cloud providers know exactly who's getting how many chips and when. Perfect visibility into competitor capacity enables coordinated deployment without collusion. The coordination is structural, not conspiratorial. They don't need secret meetings because they have perfect information. Data center build-out takes 3 to 4 years. CapEx is disclosed quarterly. GPU allocations are known. Utilization is reported. Pricing moves are visible. Everyone knows what everyone else is doing, so they match. Here's what this means for you. They're building $500 billion in infrastructure to meet surging AI demand, but maintaining artificial scarcity. Those data centers could run at 95% utilization. Google ran traditional cloud infrastructure at this rate pre-2023. Instead, they're targeting 75 to 80%. That 15 to 20% offline capacity is pure pricing power. You're paying for scarcity they're creating deliberately. Your employer's cloud bill could be 30% lower if they ran facilities at full capacity. That's $960,000 annually for the average enterprise. Money that could go to raises, hiring, product development, instead extracted through coordinated capacity discipline. This creates a prisoner's dilemma where defection is irrational. If Microsoft floods the market with cheap compute to gain share, Amazon and Google match immediately. They have the capacity offline, all three see margins collapse, but Microsoft gains no share. The Nash equilibrium is coordination. Smaller players, Oracle, IBM, regional clouds, can't break the cartel because they lack scale. Undercutting by 20% might steal some customers, but hyperscalers have 10 times their capacity. They can sustain a price war long enough to bankrupt challengers, then raise prices again. Coordination persists because breaking it is suicide. You might be thinking, this sounds like conspiracy theory. These are competitors, they want to steal each other's customers. Why would they coordinate? Here's the problem with that assumption. They learned from telecom. In the 1990s, telecom companies competed on price, driving margins to near zero. Verizon, AT&T, Sprint, brutal price wars, bankruptcies, consolidation. Survivors learned pricing discipline beats market share battles. Cloud providers watched this unfold. Look at the pattern. AWS dominated cloud with 60% market share in 2015. They could have maintained 20% margins and crushed competitors with volume. Instead, they let Azure and GCP grow to 20 and 10% share respectively, while all three maintained 30 to 40% margins. That's not competition. That's coordinated oligopoly. They chose collective rent extraction over individual market dominance. And that's how coordination happens without conspiracy. We've revealed 2 of 5 mechanisms. The third is where it becomes permanent, the lock-in engineering that makes escape impossible. This is lever 3, mechanism of control. Pattern check. We've exposed the empty core value inversion and the coordination system. Now we hit the lock-in layer, the mechanism that makes this extraction permanent. Here's why this matters to you. Your company's entire product might be one API change away from breaking. And that API is controlled by a platform charging you $3.2 million annually, with 18 to 24 months of engineering work required to leave. The average enterprise switching cost now equals 40% of annual cloud spending. That's the threshold where extraction becomes sustainable. Once you're locked in, they can raise prices 15 to 20% annually, and you'll pay, because leaving costs more than staying. Picture a contract with no exit clause. By 1650, European merchants couldn't buy spices without VOC intermediation. Alternatives had been eliminated through military force and exclusive treaties with producing regions. Exit wasn't impossible, but required rebuilding entire supply chains, estimated at 10 to 15 years of capital and negotiation. An enterprise CTO sits in a boardroom reviewing cloud bills. Usage climbed 40% this year. Costs rose 62%. The VP of engineering explains, we're locked into Azure. Our entire authentication system runs through Azure AD. Our data pipeline uses Azure-specific APIs. Our ML models deploy on Azure machine learning. Switching would require 18 months of engineering time, $8 million in costs, and massive business continuity risk. The CTO knows they're paying a vendor tax. The CTO also knows switching might cost more than 5 years of overpayment. The trap is perfect. The lock-in mechanism has 5 layers, each engineered deliberately. Layer 1, proprietary APIs. Every cloud platform offers unique interfaces for storage, compute, databases, ML services. You write code against AWS S3 API, or Azure Blob Storage, or Google Cloud Storage. Each is different. Migrating requires rewriting every line of code that touches storage. For a large application, 100,000 plus lines of API-dependent code. Layer 2, Data gravity. Once you store petabytes of training data, customer data, or operational data on a platform, moving it is prohibitively expensive. Transfer costs run 8 to 12 cents per gigabyte egress. Moving 5 petabytes costs $500,000 just in bandwidth, plus re-engineering data pipelines, testing, and business continuity risk during migration. Layer 3, service integration depth, cloud platforms, embed themselves in authentication, security with compliance certifications and audit logs, monitoring, and operational workflows. Each integration point is a switching barrier. Typical enterprise, 40 plus integrated services, each requiring replacement and recertification on new platform. Layer 4, talent lock-in. Engineers train on specific platforms. AWS certifications, Azure expertise, GCP specializations. Your workforce is human capital locked to a platform. Switching requires retraining entire teams or hiring new talent, scarce and expensive. The company's institutional knowledge is platform-specific. Layer 5, sunk costs. After investing 2 to 3 years building on a platform, the sunk cost fallacy kicks in. We've already optimized for Azure. Starting over on AWS means abandoning all that work. Psychological lock-in reinforces technical barriers. Collectively, these 5 layers create switching costs averaging 18 to 24 months of engineering effort, plus 40% of annual spending. For an enterprise, paying $3.2 million annually, switching costs $9 to $10 million in hard costs, plus opportunity costs and risk. Here's what this means for you personally. Your employer is locked in, which means cloud costs come out of the compensation budget. When cloud bills rise 20% annually, $640,000 for average enterprise, CFOs freeze headcount or limit raises. That's $640,000 not available for hiring or bonuses, extracted by lock-in rent. And if you're building AI products yourself, you're locking yourself in right now. Every model trained on Azure, every API call to AWS Bedrock, every deployment on GCP Vertex, you're building future switching costs. In 3 years, when they raise prices 50%, you'll pay. Because by then, leaving costs more than staying. The lock-in creates a competitive moat that turns customers into assets. AWS boasts 90% plus enterprise customer retention. That's not because they're beloved. It's because leaving costs 18 months of engineering time. High retention means predictable cash flow, which means cloud providers can finance $500 billion in CapEx with confidence. Customer captivity underwrites infrastructure expansion. This also creates a knowledge trap. Because everyone builds on the same 3 platforms, architectural patterns converge. Industry best practices become platform-specific practices. Conferences, training materials, open source tools, all oriented around AWS, Azure, GCP. Alternative architectures become legacy thinking. The ecosystem itself becomes a lock-in mechanism. You might be thinking, but companies choose multi-cloud strategies to avoid lock-in. And there are tools like Terraform that abstract away platform differences. Switching isn't as hard as you're claiming. Here's the problem with that assumption. Multi-cloud is expensive theater that doesn't solve lock-in. Yes, companies run some workloads on AWS, some on Azure, some on GCP, but they still get locked into each platform for those specific workloads. And running the same application across multiple clouds requires maintaining 3 codebases, tripling complexity and cost. In practice, 70% of enterprises have 80% plus of workloads on one primary cloud. Multi-cloud is a hedge, not an escape. And abstraction tools like Terraform help with infrastructure deployment, but they don't solve the deeper layers. Data gravity, integrated services, talent lock-in, or the business continuity risk of switching. You can abstract compute and storage, but you can't abstract 40 integrated services. The switching cost remains. Here's the one vulnerability that could break the lock-in mechanism. Open source alternative infrastructure at scale. If a credible, community-governed, non-profit cloud platform emerged, matching hyperscaler capabilities with open APIs and true portability, the lock-in breaks. Customers could switch without rewriting code, but here's why it hasn't happened. Building competitive infrastructure requires $50 billion plus capital and 4 to 5 years. Who finances that without expecting returns? Governments could through sovereign cloud initiatives, but face coordination problems. Open source foundations could, but lack capital. The capital requirement itself is a barrier that protects the cartel. And that's the lock-in layer, the mechanism that makes extraction permanent. We've revealed 3 of 5 mechanisms. The 4th is where the extraction actually happens, the price gouge in action. This is lever 4, price gouge, extraction in action. Pattern check. We've exposed the empty core, coordination mechanism, and lock-in engineering. Now we examine the actual wealth transfer happening right now. Here's why this matters to you. AI inference costs, running models to get answers, have dropped 90% since 2020 due to hardware improvements and algorithmic efficiency gains. But your employers? Cloud bills have increased 300% in the same period. The cost savings aren't being passed to customers. They're being captured by cloud providers as expanding margins. And because you're locked in with 18 to 24-month switching costs, you'll pay whatever they charge. An enterprise CFO reviews the budget. Cloud spending increased 45% year over year. In 1621, the VOC purchased Nutmeg in Banda Islands for 1/300th the Amsterdam selling price, extracting 30,000% markup. Customers paid because no alternative existed. The VOC had eliminated English and Portuguese competitors through warfare and exclusive treaties with spice-producing regions. The CTO explains, "Our compute usage only grew 15%. The rest is price increases and new service fees." The CFO asks, "What if we switch providers?" The CTO responds, "That's an $8 million project with 18-month timeline and significant business continuity risk." The meeting ends with approval of the cloud budget increase. Not because the CFO agrees it's fair, because the alternative is worse. That's extraction. Here's how the price gouge operates in practice. Mechanism 1. Asymmetric cost reduction versus price reduction. AI compute costs, hardware, energy per computation, have fallen 40% annually since 2020. Cloud providers reduce customer pricing 5 to 10% annually. 30 to 35% margin expansion captured by providers. Concrete example. Running GPT-4 class inference cost 50 cents per million tokens in early 2023. By late 2024, hardware efficiency improvements and batching techniques reduced actual costs to 5 cents per million tokens, a 90% decline. Customer pricing fell to 30 cents per million tokens, a 40% decline. The gap, 25 cents per million tokens, is pure margin expansion. Mechanism 2. Tiered pricing. That rewards lock-in. Cloud providers offer volume discounts up to 70% for committed spend contracts. Sounds like good deals for customers. But the mechanism is lock-in rewarding. You commit to spending $10 million over 3 years. You get 50% discount, but you're locked in for 3 years at committed volume. If your needs change, you're still paying. And after the contract ends, prices revert to full rate unless you sign another long-term commitment. The enterprise average pays $3.2 million annually, with 40% being vendor tax above competitive rates. That's $1.28 million per company per year extracted through lock-in pricing power. Mechanism 3. Service bundling and mandatory upgrades. Cloud providers increasingly bundle services. Want advanced AI features? Must use their entire ML platform. Want enterprise support? Must hit minimum spend thresholds. Want compliance certifications? Must use their security stack. Each bundled service has 60 to 70% margins. And mandatory upgrades. AWS announces Lambda functions now require upgrading to newer runtime versions. Sounds technical. The real effect forces re-engineering work that keeps you from switching. While you're busy upgrading, the window for switching closes further. Mechanism 4. Shadow pricing. Through hidden fees, data egress fees, moving data out costs 8 to 10 times more than moving it in. API call pricing charges per request, not just compute usage. Storage tiering, frequently accessed data costs 10 times more than cold storage. Network transfer between availability zones charged despite being within same provider. These fees are nearly invisible during adoption. You're moving data in, not out. They become material once you're locked in and want to leave. Data egress costs alone can run $500,000 plus for migrating 5 petabytes. Here's what this means for you. Microsoft's cloud operating margin is 70%. Compare, Walmart operates at 2.5%, Toyota at 8%, even Apple, notoriously high margin, runs 30% on hardware, requiring constant innovation. Cloud. Providers achieve 70% margins on commodity infrastructure by exploiting lock-in. Every dollar of that excess margin comes from somewhere. Higher prices for AI services, which means higher prices for AI-powered products, which means higher subscription costs for you. Your $10 per month ChatGPT subscription could be $3 per month if OpenAI paid competitive infrastructure costs. The $7 difference is rent extraction flowing through the value chain to you. And if you're in the enterprise world, your employer's $1.28 million annual vendor tax is money not available for salaries, benefits, or hiring. Cloud providers extract it through lock-in pricing power, and it comes out of the compensation budget. The price gouge creates a chilling effect on AI innovation. Startups can't compete because their infrastructure costs are 3 times higher than incumbents with volume discounts. AI product margins compress. 40% of revenue goes to cloud providers, leaving thin margins for actual product builders. This concentrates AI innovation among well-funded companies who can absorb cloud costs, locking out smaller innovators. It also creates defensive behavior. Enterprises underutilize AI capacity they're paying for because marginal costs are so high. They committed to $10 million over 3 years, but once they hit the commitment, every additional dollar of usage is full price. So they throttle usage. The infrastructure sits partially idle while companies ration access, pure deadweight loss to the economy. You might be thinking, but competition will force prices down. If AWS charges too much, customers will switch to Azure or GCP. Market forces will correct excessive pricing. Here's the problem with that assumption. Switching costs exceed price differences. If AWS raises prices 20% above competitive rates, that's $640,000 annually for a $3.2 million customer. But switching costs $9 to $10 million and takes 18 months. Mathematically, customers tolerate price premiums up to the switching cost threshold, which is 40% of annual spending. AWS can charge 40% above competitive rates before customers switch. And all 3 hyperscalers know this math. They don't compete on price below the switching cost threshold. They coordinate around it. Lever 2. Competitive dynamics require low switching costs. Here, switching costs are 40% of annual spending. That's not a competitive market. That's a hostage situation with 3 captors who've agreed not to outbid each other. And that's the extraction in action. Wealth transfer disguised as premium services. We've revealed 4 of 5 mechanisms. The final lever explains why none of this breaks. Why this cartel might last decades. This is lever 5. Necessary evil, why it persists. Pattern check. We've revealed all 5 mechanisms. Empty core value inversion, coordination without collusion, lock-in. Engineering, active price gouging, and now the final layer, why this doesn't break. Here's why this matters to you. Every previous infrastructure monopoly eventually faced disruption. Railroads, telecom, cable TV, electricity grids. The cloud cartel is different. The barriers to entry are higher than any infrastructure monopoly in history. And those barriers are growing, not shrinking. By 2027, 90% of frontier AI compute will run on 7 companies' infrastructure versus 70% in 2023. Concentration is increasing. A sovereign wealth fund manager reviews a pitch. We'll build competitive AI cloud infrastructure. $50 billion investment, 5-year timeline, targeting 5% market share. The VOC monopoly lasted 197 years, 1602 to 1799, not because Europeans loved it, but because no credible alternative existed. Building competitive spice trade infrastructure required $50 million plus in period-adjusted terms, 15 plus years, military capacity, and diplomatic relationships the VOC had already locked up. By the time alternatives emerged in 19th century colonial expansion, the VOC had extracted $1 trillion plus inflation adjusted from the intermediation position. The manager asks, "Who's your customer?" The founder responds, "Enterprises tired of hyperscaler pricing." The manager pushes, "Why would they switch? Their switching costs are 18 to 24 months. You're unproven. Hyperscalers have 15-year head starts on reliability, compliance certifications, and ecosystem. The pitch has declined, not because the opportunity isn't real, because the barriers are insurmountable. The incumbents win by default. Here's why no viable alternative emerges. Barrier 1, capital requirements, $50 billion plus minimum viable scale. To compete with AWS, Azure, GCP requires 20 plus data center campuses globally for geographic presence. $10 billion per campus for land, power infrastructure, cooling, networking. 50,000 plus GPS, $50 million per 1,000 H100s equals $2.5 billion in compute. 5+ years of operational scaling, reliability comes from years of learning. 10,000 plus engineers at $200,000 average equals $2 billion in talent annually. Total capital requirement, $50 billion minimum for credible alternative. Only entities with this capital, governments, Saudi Aramco, Apple, other hyperscalers who prefer cartel stability over competition. Barrier 2, time to market, 4 to 5 year build-out. Data centers require 3 to 4 years from land acquisition to operational. Building 20 plus globally, 4 to 5 years minimum. During this time, incumbents deepen customer lock-in, improve efficiency, and expand capacity. By the time you launch, the market has moved. Customers are 4 to 5 years deeper into incumbent lock-in. Oracle Cloud launched in 2016, the last major entrant. After 8 years and $50 billion plus invested, Oracle holds 2% market share. That's the brutal reality. Late entrants can't overcome incumbent advantages. Barrier 3, chicken and egg problem. Enterprises won't migrate mission-critical workloads to unproven infrastructure. You need scale to prove reliability, but you can't achieve scale without customers. Hyperscalers solved this 15 years ago during cloud's early adoption. Now, the market demands 5 nines reliability, 99.999% uptime from day one. No startup can deliver this without years of operational experience. Barrier 4, ecosystem lock-in. 70% of AI engineers trained on AWS, Azure, GCP. Industry conferences, certifications, best practices, all oriented around incumbents. Open source tools optimized for hyperscaler platforms. Compliance frameworks SOC 2, FedRAMP, HIPAA require years of audit history. A new entrant doesn't just compete on infrastructure, they compete against 15 years of ecosystem development. It's not technically impossible, it's economically irrational. Barrier 5, regulatory capture as formal barrier. AI safety regulations being written now. EU AI Act, US state laws. Proposed federal frameworks favor incumbents. Compliance costs estimated at $50 million plus for comprehensive coverage. Only hyperscalers can afford this, and they help write the regulations, ensuring requirements favor their architectural approaches. New entrants face $50 million compliance costs before serving a single customer. Incumbents spread this cost over massive existing customer bases. Here's what this means for you. No alternative is coming. Your employer will pay cloud bills that increase 15 to 20% annually for the next decade, and there's no escape. That's $3.2 million becoming $8.2 million by 2034 for the average enterprise. Where does that money come from? Compressed wages, delayed hiring, reduced benefits, or higher prices passed to customers, meaning you. And if you're building AI products, you're locked in for life. The switching costs grow every year, while alternatives recede further into impossibility. By 2030, cloud providers will charge 2 times current rates, and you'll pay, because leaving costs more than staying. The persistence creates a generational wealth transfer. Cloud infrastructure will generate $1 trillion plus annually by 2030 versus $200 billion in 2024. With 60 to 70% margins, that's $600 to $700 billion in annual profits extracted from productive economy and funneled to 7 companies. For context, that's 3% of US GDP captured by infrastructure rent-seeking. This also creates a civilizational dependency. By 2027, most economic activity will have AI integration, and all of it runs on cloud infrastructure. Control over compute becomes control over economic activity itself. If cloud providers decided to deprioritize certain industries or geographies to favor others, they could reshape economic development. That's not free market dynamics. That's infrastructure gatekeeping as governance. You might be thinking, but governments will regulate this. Antitrust enforcement will break up the cartel. Or governments will build sovereign cloud alternatives. There are solutions. Here's the problem with that assumption. Governments move slowly and tech moves fast. By the time antitrust cases resolve, 5 to 10 years, customer lock-in will be absolute. EU fined Microsoft $8 billion over 15 years for browser bundling. Microsoft paid the fines and kept bundling. Antitrust is expensive theater that doesn't solve the underlying problem. And sovereign cloud initiatives face the same barriers. $50 billion capital, 5-year timelines, talent scarcity, ecosystem gaps. France's OVH cloud, Germany's sovereign cloud plans, all struggling to achieve scale. China's approach, Alibaba Cloud, Tencent Cloud, works domestically but doesn't solve global dependency on Western hyperscalers for most enterprises. The brutal reality. Governments lack the capability and coordination to build competitive alternatives at scale. The cartel persists because the barriers it's erected are insurmountable through any realistic mechanism, market, regulatory, or sovereign. Those are the 5 mechanisms: empty core extraction, coordinated capacity discipline, lock-in engineering, active price gouging, and insurmountable barriers to alternatives. The patterns complete. Here's what happens next. The patterns complete. 5 mechanisms working in concert. Empty core value inversion, capturing 70% margins on key commodity infrastructure. Coordinated capacity discipline, maintaining artificial scarcity. Lock-in engineering, creating 18 to 24-month switching costs. Active price gouging, extracting $1.28 million annually per enterprise. And insurmountable $50 billion plus barriers preventing alternatives. We're at the extraction phase, just like the Dutch East India Company in 1650, 48 years into a 97-year run. The infrastructure is built, customers are locked in, and price increases accelerate. Your employer will pay 15 to 20% more annually for the next decade. No alternative exists. The question isn't if they extract, it's whether you notice before your switching costs exceed your company's annual profit.